Welcome back to yet another episode of the Syllables. We're going to talk today about shorting. We are Vlad and Levi. We are Vlad D35 and Lizia Pukaya on eToro, two popular investors trading our ways through the markets, trying to stay in green as much as possible. In the descriptions down below, you can see the links. You can follow. You can check us out, see what we are up to on eToro. And now back to the topic. We are going to talk about shorting today. Why?
Why? So I think, first of all, this is a very, very controversial topic. You and I are both on the opposite spectrums of this topic. But in order for our viewers to better understand what we're going to talk about, shorting is, in short, it's betting against a certain asset. So, for example, if you think that Tesla will go down and then you want to make some money based on this, then you're going to short Tesla. But then, of course, there are certain risks, certain benefits that we're going to discuss about this in a second. But yes, coming back to your question, to short or not to short?
In short.
In short.
Shortly on Syllables.
This is a short.
I really want to first explain the very concept of shorting. Basically, in order to short something, and a normal transaction in the stock market has two parts. Once when you go and buy the stuff that you want to invest in, and then the second is when you, if you're happy with the price appreciation, hopefully it went up, you sell it. That's only two moments of the transaction that takes place. When it comes to shorting, it has three parts, and that's important to understand. First, you need to borrow the thing that you want to sell. This is the key how shorting works traditionally in the Wall Street. In platforms like eToro, it's done through something called a CFD. That's a contract for difference. So that's basically a bet against the price. But strictly talking about the traditional way, here is this pan. Vlad says, I want to short this pan because I think the value of pans will go down in the future for whatever reason. Someone gonna, invent telepathy, and we don't gonna write enough. Whatever, you get my point. So he says he believes the price of the pan is gonna go down, so he borrows this pan from me because he doesn't have any pans, but I do have one. So he borrows. I give this pan to Vlad, pass it on, and now he has the pan. And he pays me a commission for this basically borrowing the pan. It's like a very minimal fee that traders pay to the brokers. And then he goes to the open market, the one that is behind him in his background, and he says, "Hey guys, who wants to buy a pan?" He sells this pan, let's say $10, okay? But he owes me the pan because I gave it to him. He borrowed it from me. 2 weeks later, he is right. His theory turns out to be correct, and the price of the pan, the market price, is now not $10, it's $5. So what he does, he goes out to the market where he previously sold this pan for $10, and he has the $10 in his pocket, and he takes $5 out from that pan, buys this pan back on the open market, gives me my pan back. So I'm still got my pan. I'm happy. He, on the other hand, has $5 of profit in his pocket because he only bought that pan back for a $5, whereas he sold it for 10. I think this is the quickest and simplest explanation of how shorting works. And now going back to eToro and other platforms, you do it through a CFD. So you just basically, with 2 clicks of a button, you bet against the price and say, I believe this price of the pan or Tesla or oil or gold or whatever you want to short gonna go down, and if you're right, you profit from it. If you're wrong, you don't.
Yeah, I think that was a pretty thorough explanation. I mean, put it into simple terms of how shorting works. But now I'm going to give you like my take on shorting.
Okay.
And then I'm really curious to hear your counter arguments, because as you mentioned before with the pen, I think we're gonna use this pen example all throughout this episode.
Definitely, it will be the sell me this pen.
Jordan Belfort style. So there's, first of all, the price action. I mean, I'm gonna borrow this one from you. I'm gonna borrow the pen from you. But then you said, I mean, this is one of the requisites of shorting. You're gonna say, okay, I'm gonna borrow this one to you for at most X days, X months. I mean, this contract is gonna expire at some point. And if I'm not happy with the price action up until that moment, then the contract will automatically fulfill. So I will have to buy back the pen at whatever the price it is at that moment. And you, of course, you will get your pen back. Plus your commission is also something that we need to take into account. So you might be right, or in this case, I might be right, you know, about the price going down, or at least the price being overvalued at this particular moment. So in the long run, it should go down. But what if the market is crazy enough and then it doesn't go down as it should be? So the contract expires, and then I'm left, naked in the market, and I have to, you know, pay back, do everything.
Yeah, basically you would stand there with your pants down, and you have to give the pen back, and also have to pay all the commission along the way. That's a very valid question, but I presume that 99.9% of the people who want to watch this video, wants to understand shorting, doesn't impact them. The reason being is because they, like I do, like you would do if you ever decided to do shorting, you would probably, again, 99% of the situations, you would do it through a CFD, and the CFD has no expiry date. So a CFD position can stay open as long as you want to keep it open, presuming that you pay the commissions on an overnight basis to the platform. In those situations that you mentioned, that when there is an actual broker who lends the pen to the trader, who are you in this example, yes, there are often expiry dates or contracts on how long I want to borrow this this pen from you, or actually you borrow it from me. But again, I think those who have access to those kind of brokerage services to actually borrow the shares of a company. Now, in this particular case, let's talk about the actual thing instead of the pen metaphor. If I'm a trader and if I'm big enough to go to a broker house or a broker and borrow those shares, these guys know exactly what shorting is. And for average mortals like you, me, and presumably, guys, no offense, anyone watching this channel, shorting will be done through a CFD contract, and as such, you don't have to worry about the expiry date of a contract. Of course, you should take into consideration that there is a commission that you pay for the platform, because most platforms charge a commission to keep CFD contracts opened. That's part of the game. So that's pretty much means that you should be, you know, extra thorough and done your due diligence and make a bet on the price going to go down, that you know what you're doing, and you are prepared that if you are wrong, you're not only losing the difference because the price went up when you were short, but you also, there is an extra little fee that you lose, that is your commission to the platform.
Yeah. And on a second note, I mean, going long, that's my strategy. I've always been a long-term guy. There you invest a sum. So let's say $100.
Yeah.
Your investment can at most lose 100% of its value. So it would go to zero.
Without leverage, yes.
Exactly. Now we're going to talk right now about traditional trades, so no leverage. So it can go down at most 100%. So it goes from 100 to zero. Yeah. But the possible gains are infinite, because it can go, I mean, if the prices of one pen is $10, for whatever reason in the future, one pen can be $1,000.
Yeah, exactly. I see exactly where you're going. I get this question so many times.
So then you switch this around and you say, I'm going to short, and then you're going to bet against it. The most you can win from a pen going from $10 to zero is 100%, whereas the most you can lose is infinite. Is this risk-reward ratio worth it?
I wanted to to refer back to that, what you just said at the very beginning, that your strategy is to go long. That's perfectly fine. My strategy is also to go long. Going short is not a strategy. Going short is just a technique to benefit from certain price movements or benefit from certain situations on the market. But anyone who claims that his long-term investment strategy is to short the market or short certain assets is an idiot, okay? Because of the exact reasons that you just explained.
Exactly. Plus, just look at the long-term movement of the S&P 500, guys.
Exactly. Prices, historically prices tend to go up. Like shorting, in my opinion, the way how I use short, about 80-90% of the times when I actually decide to go short on a certain asset, I use it as a hedge. I use it as a risk management technique to basically cover my profits on the long positions, because I see some kind of danger or possibility ahead that could, send my long positions into a dip. But I don't want to be the guy who just sits tight and sees how his positions goes to red and then hopes that please soon are going to go up again. I'm a bit more active than that. I try to hedge and take advantage of the down movements as well. And this being said, there is an interesting technique that I like to use, and I think this is exactly how people should look at shorting and maybe start thinking about building it into their strategies, like overarching investment strategy, right? And I'll give you an example because this happened and it's happening, so I know that it's proven. Let's say there is an industry that is being dragged up and down because of the economic developments, the airlines and air traffic and tourism, right? So there are days when airlines are up 5%, 6%. We all saw this happening in the last 2 years, ever since the pandemic hit. And I think that the main reason I ended up in eToro was because I started to short airlines in March 2020 and gave me 90% return in a single month, because it was such an apparent and obvious short play back then. But that's a different story. So there are airlines, okay, and we have different opinions. Some people say airlines gonna thrive in the long term because now they are pressed and undervalued, but once the pandemic is truly behind us, they're gonna fly, literally. Whereas there are some other guys like Warren Buffett who completely exited his airline positions, saying that the industry is fundamentally changed, so it's no longer attractive for him, which is coming from a guy who made shit tons of money. And he says he never usually sells an investment, he holds forever. That's something interesting to take into account.
Yeah.
So
I love this quote from him. Our ideal holding time
is forever. Yeah, exactly. Yeah, he's a great fella. And the thing is that I personally think that long-term airlines are having a tough time ahead. But here's the thing: that's an industry. That's the entire industry with dozens of companies in it. So what you can do, what I like to do, and it also did before, that these airlines are not equal. Some of them are doing better, some of them are doing shit. You do your analysis, you do your due diligence, you go look into their balance sheets and look into their outlooks, and you can separate the good ones from the bad ones. So here comes the thing. And again, with real life example, I go long on Wizz Air because I think they are fundamentally the financially strong airline who prove that they can manage to weather the storm of the pandemic. But there are some quite shitty ones. Okay, it's easier to find shitty ones that are struggling. EasyJet, Norwegian, IAG, that is the owner, the parent company of British Airways. Anyways, I'm not going into deep stock analysis here. From a shorting standpoint, I go long on Wizz Air because I believe in the company to deliver value in the long term, but simultaneously I go short on EasyJet or on Norwegian. By doing so, basically what I'm betting on is that the price of Wizz Air are going to go up, the price of EasyJet is going to go down. But if there is anything, any given day or week or month when there are developments that impact the entire airline industry and drag the prices up, down, there is a saying that goes, the tide lifts all boats. So if there is this development that basically there's a news coming out, there's a new variant, okay, all the airlines going to go down. But if my analysis is correct, on the long term, Wizz Air going to do well because they're a well-run company, but EasyJet not going to do so well and going to either remain flat or go down. Best case scenario, I profit from both. Worst case scenario, one is hedging the other, so I also remain flat. These kind of strategies are the situations when shorting can be super useful. Okay.
Yeah, but you have to be fair that there is also the worst case scenario where you lose from both.
Yeah, but in that case, you shouldn't do investing. If you can't, I mean, seriously, if you look into a balance sheet of two companies, I give you two balance sheets and I tell you, please pick the one that you believe gonna do better in the long term. And someone can't read that out from debt levels, from how the company spends its capital, how the company makes its profit, how much profit it retains. I mean, this is investment 101. So I understand that people come to me sometimes say, well, shorting is risky because what if you are wrong? Well, the same stands if you go long. What if you are wrong? What if you are wrong with the long analysis?
Yes, but what if you're long? I mean, we're coming back to the initial point. If you're wrong on your long analysis, then you lose 100% of your investment. If you're wrong on your short investment or your short position, then you can lose way more. And then as you countered it before, you said, okay, you stop losses and everything. I hate stop losses because I'm only going into a certain position, into a certain company, if I'm convinced about it. So I don't really care about these short term, this noise, this volatility. That's most often than not, it's just silliness of the markets.
Yeah.
So why would I risk triggering a stop loss for something that's super short term? So just to cover my losses, whereas I could invest and be convinced that in X amount of time, convinced, of course, there's no such thing as high conviction in investing, but I strongly believe that in X amount of time, my investment will go up. Even if it goes down sideways circles, just imagine that my face is Matthew McConaughey.
Yeah, I know. Yeah,
right now. Then I can simply consolidate my position on that one. So I'm going to give you an example right now. So for example, Tesla.
Here is the thing, and I am super strongly resisting the temptation now to go into a Tesla conversation because I don't.
That's not the topic of this, of course.
Yeah. But let's just put it this way: Tesla is a company that divides people. That's for a fact. We know that, and this is exactly the kind of stock that you should not short at all. I burned myself a couple of times, not with Tesla. I occasionally short Tesla when I have some malfunctioning and I decide to go. But the very reason why you should, and this is like this kind of kids don't try this at home kind of advice. And this takes us to what are the scenarios when you shouldn't short, is when there is a company that is such that divisive, like the divides people, and that has so much extremely popular, because these are the kind of stocks that tends to be super volatile, like Tesla, and these are the kind of stocks that has so strong camps on both sides that kind of drag the price up down. And especially when there is a stock like Tesla, and I can't avoid to go into a little bit of a Tesla analysis here in relation to the wider market. When Tesla staged its super rally in the last 2 years, the price went from shit lows to all the highs that we know. It was in the backdrop, the entire market was rallying, and it was a huge optimism, and tech stocks were rallying. So I think the explanation partly for the reason that Tesla's PE now is shrinking, because the company's results are stepping up and up and up, but the price remains flat, is because the market ran into a flat resistance and a broader picture. But again, I burned myself with companies like Zoom when it was super popular. I was betting, I admit this, because I believe in looking into your trading mistakes is super important. I was betting against Zoom when it was trading at $150, and I said there is no way this shit gonna go to 200, and we all know how that panned out. I made a mistake. I was betting against a company that was a market favorite, and you never bet against a market favorite. That's the lesson I learned, because no matter how smart your analysis is, simply the fact that people want to push the price up because they love the stock, because there is a huge positive, atmosphere around the company on its own, more than enough to I don't want to use bad analogies, but just to and that's what would happen to your short position.
If you look back and say you look back on the crisis of from the 2008, there is like one investment hero from this whole scenario, which is Dr. Michael Burry. He realized that, oh, it's gonna hit the fan, it's bad. So he started betting on it, and then even though it was a very, very tough patch for him, because nobody likes somebody that's negative, and we're gonna have a crash, it's gonna be bad. So he lost a lot of customers back then. It was tough. I mean, for those of you that don't really know the story, go back,
watch the movie.
Watch the movie, the Big Short.
It's worth it. Yeah, that's it. Big Short. If you haven't seen it, it's a must. Yeah,
exactly. Or and then if you want to go a bit more in detail and understand why his analysis was so good, go and look on Inside Job.
Yeah,
I think that one was even better than the Big Short. But anyways, still he got burned shorting Tesla exactly for the reasons you mentioned before. So even if you are the big brain inside investing, you still have a very, very, very high chance of burning yourself.
I totally agree with you that, guys, even people like Michael Burry burns himself with shorting a certain stock, particularly Tesla, it shows clearly how risky shorting is. So guys, I think we are nearing towards an end here and towards a wrap up, because I think everything that could be said about shorting has been said. Of course, there are some other nuances to shorting an asset that if you want to find out more about, this is a little bit of a shameless self-promo. Come to eToro, check out how it's done. Exactly, links down there. So again, just to wrap this up, guys, it's not an evil thing like some people think. It's not a moral trouble to go against the company. If there's a company worth to be shorted, it means the company already done some damage to itself. So just like always, do your due diligence, do your analysis, look into balance sheets, look into companies, make up your own mind. But shorting shouldn't be something to be afraid of. Shorting is just a risk management tool, just a hedging technique, nothing more. I think pretty much that's it. So again, buddy, is there anything that is left inside about?
No, that's pretty much it. I mean, I completely agree. There's no moral dilemma in shorting. And then, of course, these investment decisions should be solely made based on financial data. Of course, there is some ups and downs, some extra glitter that the media is gonna put into these investment decisions. Anyways, you guys, I mean, we try to present as well as we could like the risks and the benefits of shorting. Main point is just be careful whatever you do, and then always do your due diligence, and then stay tuned for the next episode of the Silly Bulls. Thank you guys for checking.
See you guys next time.
See ya.